Hi everybody, Thomas at Rebel Income here. In an environment of high interest rates fueled by inflation, cyclical industries tend to be among the most sensitive to increasing cost pressures. For investors, including bargain hunters, that usually means that those industries, which include, for example, the auto industry, are better left to wait for the period where rates begin to go down. It's where I find a little bit of irony in the stock that I'm going to be talking about today. BorgWarner is an auto parts and components manufacturer that might not be easily recognized by the average consumer, but that occupies a leading position in the auto parts and equipment industry group. After dropping from a peak in the summer at around $48 to a low to start December at around $32, the stock has been picking up bullish momentum. Now, that's interesting for short-term traders, but what about value investors like me? Let's try to find out if BorgWarner is a stock that's worth paying attention to. We can see BorgWarner's peak that occurred from July through August at around $48 per share. The downward trend to the early part of December is also very clear and is accentuated by the 200-day moving average, which we can see is sloping downward. Now, in the last couple of weeks, as I already mentioned, the stock has been picking up some bullish momentum and crossed above the 20-day moving average, which is a bullish signal, and has been rallying up to about $36 per share. Now, the pattern of the 20 and the 200-day moving averages set up an interesting bullish level 2 kind of a pattern, with the stock's latest momentum providing a signal for short-term traders sometime last week. There's also about $4 of difference between the stock's current price and where the 200-day moving average sits, which may make the stock tempting fodder for short-term bullish traders to think about taking a new position. This kind of pattern can also act as an early indication of a potential longer-term trend reversal, which is another reason value investors like to try to recognize these kinds of patterns. The real question, though, along with the technical pattern, is whether or not the company's fundamentals are strong enough to support the idea that the stock could be offering a useful value right now. So let's go ahead and let's dive into those numbers and take a look at the fundamental profile. Free cash flow over the last 12 months is a little under $600 million. Now that represents a decline from about $869 million a year ago and about $615 in the last quarter. Both of those declines are reflective of increasing cost pressures in an inflationary environment. Even so, and despite that overall decline, the company's overall free cash flow does translate to a useful free cash flow yield of about 7%. The company's balance sheet also looks relatively healthy. It has not been immune from the declines that I've been talking about over the last year. Cash and liquid assets declined from a little over $1 billion to $949 million in the last quarter. Counter to that is the fact that in the last quarter, cash and liquid assets increased by about $100 million from $848 in the quarter prior. So that's a positive indication, along with the reality that the company has been reducing its long-term debt. Long-term debt right now is at about $3.6 billion and came down from just a little under $4.2 billion in the last quarter. That's a positive trend, showing that they retired about $500 million of long-term debt. I mentioned that the declining free cash flow pattern was reflective, I believe, of increasing cost pressures in an inflationary environment. Also, reality of high interest rates and the pressures they put on consumer prices when it comes to things like new auto sales. That has a direct impact on a company like BorgWarner, who supplies auto components and equipment to manufacturers, as well as focusing on aftermarket sales. You can see that in the last 12 months, net income as a percentage of revenue was about 4.42% and decreased in the last quarter to 1.38%. That decline is a concern, and it does mean that the company's profit margins are contracting, and that's something to pay attention to in the quarters ahead. As a value investor, I like to focus on dividend-paying stocks, but one of the things that I don't put a lot of emphasis on is how high the dividend actually is. Higher dividends obviously tend to be more attractive than lower, but my primary criteria when it comes to looking for dividend-paying stocks is that they pay a dividend, and BorgWarner fits that category. With a dividend of 44 cents per share per year, that equates to an annualized dividend yield of about 1.22%. Again, that's modest, not especially high, but the more important element here is that the company does pay a dividend, and they've been actively focused not only in maintaining their dividend, but also focusing on stock repurchases, which the market tends to view favorably. With all that said, the company's value proposition looks very interesting. Mind you, the stock's current price is right at around $36 per share, and my fair value target price, based on my Rebel Income fair value analysis, is at around $63.50 per share. That suggests that the stock has about 77% of upside. That's very interesting and very tempting. When you add in even the modest dividend, you're looking at a potential long-term opportunity of about 78%. Value proposition is interesting, and it does look like the company's fundamentals, despite some pressures, are strong enough to support that value proposition. The next question that you should be asking, of course, as always, is to think about what is the overall reward to risk in the stock right now. With it starting to pick up some bullish momentum, that's likely to pick up some interested bullish investors. But the question is whether or not there is enough reward to justify taking that position, or does the amount of risk offset that potential reward? BorgWarner's current price is in an interesting spot at around $36 because it sits roughly in between a gap that occurred at the end of October, the beginning of November. For a lot of traders, that begs the question of where support or resistance for the stock might be. One of the things that I've learned to use in these cases is going to be the last significant pivot low point, which was a support point for the stock prior to the gap. In this case, that is right at around $36.50 and just a little bit above the stock's current price. That's going to be my level of immediate resistance. For current support, again, I can rely on previous pivots to try to identify those levels. And we do have a significant pivot high that occurred in mid-November for this stock, a little bit below 35. I'll go ahead and put that at $34.50. Those are my primary levels for support and resistance. With the stock so close to $36.50 approaching resistance, the question in both cases are where secondary levels may be. Again, using my previous pivots, I can see quite a bit of activity at around $38 per share, which means if the stock breaks above $36.50, there's about $1.50 of possible upside from that point. If the stock breaks down below $34.50, if it drops below that point, then the stock's next support point should probably be at around $32.50, again based on a previous pivot low. With all of these levels in place, I can begin to think about reward to risk, potential upside to potential downside. Right now, the stock is only about 50% away from immediate resistance and about $1.50 away from current support, meaning that immediate reward to risk is 0.5 to 1.5. Certainly not practical for any kind of a near-term trade. However, if the stock can push above $36.50, then in that case, reward to risk shifts to about $1.50 of upside from $36.50 to $38 against between 50 and 75 cents of downside, depending on how quickly you get into the stock and assuming you use $36.50 as expected next support. I'll go ahead and put that at 0.5 downside, which means actual reward to risk in that case would be about 3 to 1. That means the stock is not really set up right now for a great signal. However, if we do see a push above $36.50, I would consider that a good opportunity to think about taking a short-term trade. What about value? If you want to talk about the highest probability opportunity, a break above $36.50 along with the value proposition would make BorgWarner a very good-looking bargain. Thanks, everybody. I hope this has been useful as always. If you like my content, please do go ahead and subscribe to my channel by clicking the link shown right here. You can also learn more about the Rebel Income System by clicking on this video. If you'd like to subscribe to my Rebel Income reports and trading alerts, you can do that by clicking on the link shown in the description area for this video. Thanks again, everybody. This is Thomas at Rebel Income. Talk to you again soon.